Hello, chart watchers, and welcome to this Wednesday, January 17th Market Watchers live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. It's great to have you all. First, I wanted to go over give you a quick market update today. You can see that the Dow Jones, S&P 500, NASDAQ, and the Russell 2000 all trying to recover from yesterday's selling after the opening bell on Tuesday. So far, so good. Got the 10-year Treasury yield making its way back up. We did gap higher on the yield earlier, went back, filled the gap, and now back on the rise again, heading back toward 260. The consumer staples area and utilities, two of the defensive areas of the market, actually having the strongest days. We have seen the utilities pull back a little bit from the open. And then the weak group earlier in the session was financials, but we have seen the financials break back into positive territory at last check. All 9 sectors are higher. Bank index, you can see after falling earlier in the session, rallying back on the heels of some pretty strong earnings reports. Bank of America reported this morning after gapping down originally. We did come back up and now getting closer to that flat line. Goldman Sachs also reported very strong earnings today, gapped up at the open, sold off, and now starting to make a recovery. And finally, GE, after a pretty nice rebound off of a lot of selling over the past couple of months, starting to move back lower and test those recent lows. GE having a really rough day and the worst performing stock in the Dow today. With that, I'll bring in my co-host, Aaron. How are you doing this morning, Aaron?
I'm doing just fine. Nice sunny day, of course, in Southern California. And I have a Ducks game tonight. So we're playing the Pens, the Stanley Cup champions. So looking forward to it, hoping to get a win. But, it's been a rough year.
Yeah, you could probably play the Pens out in my front yard today. I'm in South Carolina, and we've got snow. It's snowing right now. I am not happy. I've spent the last 8 to 10 years moving one state further south every few years, and it looks like I need to go one more. I need to go to Georgia. I need to get away from this. Anyhow, this is a big day. We do have a special guest. Tom McClellan is here. How are you doing this morning, Tom?
Good to be with you.
It is awesome to have you. We have a couple of indicators. I know a lot of stock charts users use your indicators, and who else could we have here to explain how they work and all? So we're going to get back to you here in about 5 or 10 minutes. But so glad to have you today. And Aaron, I'm going to let you go through, maybe talk about a couple of upcoming announcements.
Sure. All right. So tomorrow we're going to have Greg Schnell on. He's going to do some point and figure. I know we have some point and figure fans out there. I'm going to be doing a workshop on Friday, basically going over our decision point market indicators. So probably the McClellan Oscillator will probably fall in there too. Wednesday's agenda. What do we have up? Of course, Tom McClellan's here, and he's going to talk all about the McClellan Oscillator. I can't wait. 10 and 10 to 1. Our very first stock is going to be Finisar. I think Finisar, FNSR, Finisar Corp. Finally, we're going to end with bear market analysis. And I know a lot of people are asking, how can we recognize when we're topping into a bear market? So we're going to talk a little bit about our strategies for analysis of a bear market. And that pretty much is going to fill up the day. And with that, I'm going to pass it back to you and see what technical news you have out there as far as reports and such.
Okay, first let's start with the economic news out this morning. We had the December industrial production numbers come out this morning. They rose 0.9%. The market was only expecting 0.4%. December capacity utilization came in at 77.9%. The market was expecting 77.3%. So a couple of pretty good reports there. January housing market index did come in a little lower than expected, though. Came in at 72 versus 73. And later this afternoon, the Beige Book will be released 2 p.m. Eastern Standard Time. And that is a report that just kind of gives us some economic conditions around different districts around the country. And these are typically released a couple of weeks before a monetary policy meeting of the Fed. So a lot of this information that we see in the beige book later this afternoon, a lot of that information is discussed at these Fed meetings to determine interest rate policy going forward. So traders always looking to get a hold of that. Your chart on your screen here, this is the 10-year Treasury yield. It is a long-term 5-year weekly chart, but you can see with, again, the strength that we've seen in the yield, weakness in Treasury prices, but the strength in the yield now taking us up very close to a key 260 to 262 area, a breakout which I think would be very bullish for equities because, again, when your Treasury yield is rising, that means that Treasury prices are declining. And a lot of times when that is the case and the strength of the economy is causing the selling of bonds, a lot of times the proceeds of those sales turn around and get reinvested in equities. So there's a lot of history that shows short-term movements up in Treasury yields tend to coincide with moves higher in equity prices as well. So that is certainly something to keep an eye on. I do want to mention before I get into some of the earnings reports, when you look at the sector summary, and I've gone back into the member dashboard, found that they're on the left side of the screen. You can take a look and see today that two of the three top performing sectors, consumer staples and healthcare, are among defensive sectors. And technology is the only one in the top half of the leaderboard that actually is a more aggressive index. And when we look back over the last 3 months, when we've had this huge run up in the market, take a look at what's been leading. It's been consumer discretionary. We do have leadership from energy, but then financials, industrials, and technology. These are the four groups that are very aggressive, and these are the groups that you want to see leading the market to the upside because it does tell you that investors and traders have an appetite for risk, and that is typically what we see to sustain a bull market. So while the last 3 months look good, again, if we zero in on today's action, and this is only one day, but we are bouncing back with two of the three defensive groups leading today, and that makes me just a little bit nervous about this rally. Now, what doesn't make me nervous about this rally is if we zero in technology, look what is leading: semiconductors. This has been an extremely bullish group throughout much of the recent bull market, and you can see after a beautiful move higher, we had a cup in play, pulled back, put in a handle, and it looks like today we're trying to make a very significant technical breakout in the semiconductors. So that is certainly an area to watch. If I switch over to the consumer staples area, the tires index having a really strong day. And this is just following what we had talked about recently. The overall downtrend in the tire index appears to have ended. We're now acting very bullishly, bouncing off the rising 20-day moving average on the daily chart. And if we stretch this out to a weekly basis, you'll see that we had a downtrend in play for the better part of 2017. It looks like we have now broken that. We've got a MACD that's made a bullish center line cross. So this is a group that is starting to show a lot more strength. In earnings news today, first let's pull up Bank of America. Revenues came in slightly below expectations, $20.44 billion. The market was looking for $21.28 billion. But bottom line, Bank of America did exceed expectations, 47 cents versus 44. A little bit of a mixed picture here. Yesterday, off of an uptrend, you can see that black candle that prints. That black candle, any kind of a filled candle like this, tells you that you're closing below the open. The difference between that black candle and a red filled candle is that with the black filled candle, you do still finish higher for the day. So if you're just looking at the close yesterday versus the day before, you'll see that we actually did close higher, but we closed way below the open. That's what triggers the black candle. And off of an uptrend, that is typically a reversing signal. And you can see the action today. We did certainly go down today following that black candle. But the good news is so far we're holding on to the rising 20-day moving average. So a little bit of a mixed picture there on Bank of America with a lot of good news built in to the bank prices. We've talked about that. Saw a couple of really good reports out last week with JP Morgan. Now we've got Bank of America today. Another good report came out from USB, which is US Bancorp. Again, we came up just slightly lower than expected on the revenues, $5.585 billion versus 5.592. So a very slight miss there and a slight beat, though, on the bottom line, 88 cents versus 87. Again, we had that black candle print yesterday. Big move down, but notice we stopped right at about price support near the 55.5 level. Also, the rising 20-day moving average coming in at that area as well. So not bad action. I think technically you could almost expect off that black candle, even with some pretty good news. I think, again, with the huge move up that we've seen in many of these banks over the last month, even the last 3 or 4 months, a lot of the good news, in my opinion, is built into the price. So it's important to see how these stocks react and to see whether or not we can get movement back up to highs or not. Another financial stock, Goldman Sachs. Big beat on the top line, $7.83 billion in revenues. Market was looking for $7.63 billion. On the EPS, 568 versus 490. So a really nice beat on Goldman Sachs. We had a gap up, couldn't penetrate the earlier highs in December. And look at this reversal, went all the way back down, tested the 50-day moving average before reversing back up. But we're still down about $5 or so, a little more than $5 on Goldman Sachs today. One more financial, Charles Schwab, SCHW. After a little bit of earlier weakness, we actually are breaking to a new high today and trying to take out yesterday's high. So this action continues to be very bullish with Schwab. Even though with the breakout, we do have a negative divergence. We do have a slightly lower MACD, though it's climbing. And we'll have to wait to see whether or not we can break, continue moving higher and see that MACD take out the earlier MACD that we saw back in December. The last stock that I have from an earnings perspective, this is a Dutch semiconductor company, ASML, and this seems to have airlifted the semiconductors today. The company came out with numbers that just blew away estimates. $3.02 billion in revenues. The market was only looking for 2.49. So that's about 20%, maybe a little more than 20% above expectations. And bottom line, $1.77. The market was looking for $1.25. So a huge beat in ASML. You can see the huge rally here. A number of the semiconductor companies are rising in sympathy. I was looking earlier, Applied Materials making a breakout here. I think it might have been Micron I was looking at. Let me see. No, Micron was not the one. May have been KLA-10 Core. Yep, another big move here. Also, Lam Research, LRCX. You can see nice little breakout here. Seems to be starting to make this move back up to test the earlier highs back in November on many of these large semiconductor stocks. So something to keep in mind. So we got a mixed picture. We got defensive areas, a couple of the defensive areas leading today's rally, but then we also, on the other hand, are seeing strength in areas like semiconductors that generally require a lot of risk being taken by traders. So again, a little bit of a mixed bag. After yesterday's move to the downside, though, I'm being a little bit more cautious today. We'll have to wait to see whether we can clear those highs that were established yesterday. One last thing, go through a couple of upgrades and downgrades. IBM upgraded again today. We've been seeing a lot of strength in IBM shares after we had the gap up with earnings that beat Wall Street estimates back in October, pulled all the way back, nearly filled the gap, and now you can see that the uptrend is resuming. Stock continues to push higher. IBM is looking to have a much better 2018 based on the technical picture at this point in time. Groupon got an upgrade and doesn't seem to matter. We are still trending below that 20-day moving average. I would be careful until we see a rally on Groupon back above that level. Next up is LLL. This is level 3 or L3 Technologies. Yesterday actually put in a reversing candle, but with the upgrade did gap up above it. They don't always work, and this one certainly didn't. LLL is very overbought, as you can see from the RSI down below, and the MACD is very stretched, but at least at this point in time, the market could care less. And then this is Ball Corporation, BLL. Nice gap up with this upgrade, but it was in a downtrend, and you can see that that is a shooting star candle and a failure so far at the 50-day moving average. Notice that back in early December, that's where the last failure occurred. So technically, this is a pretty significant candle unless we can strengthen later today. A couple stocks on the other side getting downgrades. HPQ, which is HP Inc., got a downgrade. It opened lower, but we continue to push higher on HPQ. Certainly nothing bad technically there. GG, which is Gold Corp, also was downgraded. But after this huge move and a gap down to challenge yesterday's open, really not a whole lot of movement back and forth. We're just kind of consolidating in that area. DISH, which is Dish Network Corp. This one did gap down, is potentially taking a pretty big support level out today with heavy volume. We'll have to see whether or not we close below that level, but certainly not looking very good there. NUVA, which is Nuvasive, also with a downgrade, and another one that is threatening a breakdown so far, printing a hollow candle, though off of a downtrend. If we can continue to strengthen off of this, the move earlier today to the downside, that would be a positive for NUVA. And the last one is Juniper Networks, JNPR. After a gap down to test the 50-day moving average, we did have a negative divergence. Well, technically we didn't because we never took out that prior close. But after consolidating here for the past 6 weeks or so, the gap down actually tested a recent support level and that rising 50-day moving average. And so far, Juniper's been able to bounce off of that. So with that, I'm not going to wait any longer. I would like to get Mr. McClellan in. So, Tom, I know you've got a great presentation lined up for everybody. I'm just going to go ahead and let you take it away, my friend.
Okay, thanks very much. And I'm going to share my screen. I'm going through the switchology that you guys instructed me on. Hopefully this will all work. And you're seeing my opening slide?
Yes, we got it perfect.
Well, want to tell you, your viewers and your listeners about what the heck they should think about the McClellan Oscillator. This is an indicator that my parents developed. I was not involved. I was much more interested in Hot Wheels cars at the time that they were doing the initial work back in 1969. For viewers that are just coming into the stock market in the last year, it may be worthwhile to review a little bit of stock market humor. This is a cartoon I say from 1996. What's it actually like to be in a bear market? Some people who are new to investing just recently don't know that, never heard of that. So when we eventually get to have one, they'll get to find out the answer to that. Here's one answer to that. This is the new high, new low list from October 20th, 1987. And you can see that there's not enough room on the page for all of them.
That is hilarious.
we got to save that one. So it was my parents, Sherman and Marion McClellan, that did the work to create what became later known as the McClellan Oscillator. That was not a name that they applied to it. There was a TV show in Los Angeles back in the 1960s and 70s on KWHY, which is the very first business channel ever. They were a local UHF station on Channel 22 and would cover market news. They invented things like the scrolling ticker at the bottom of the screen. They'd say, well, let's find out what the prices are doing. We'll go to the boards. And the boards were these big, enormous walls with odometer-style wheels that would turn and clickety-clack so that you could update wheat prices and get a quote on things. That was the technology of the day. And there was a show that was called Charting the Market, shown by Gene Morgan back then. And he invited people who came up with an interesting charter indicator to come on the show. And my parents had done some experimenting around with advanced decline statistics. And my dad called up Gene Morgan and said, hey, I got something you might want to see. And it was Gene Morgan who came to call the indicator that they had created, the McClellan Oscillator. He had to call it something. And so it was his idea to name it after them. What they were looking at is advances and declines. And here's just a snapshot from the Wall Street Journal's website. You have the number of stocks going up as the advances. You have the declines as the stocks that go down. If you look at the difference between those, that's called the daily breadth. And in this case, from this one day that I took as an example, it was plus 2,104. And so that's your daily breadth for that day. That's a nice strong up day. Okay. And so then you can plot the daily breadth on a chart. Here's the daily plots back from January 1995 is this example chart. And you know, you have a period of increasing numbers and decreasing numbers. And the math that my parents applied to it was called exponential moving averages, because they were followers of a guy named Pete Harlan, who was an actual rocket scientist at JPL, who was the one who introduced the use of exponential moving averages to stock market tracking. He didn't call them exponential moving averages. What he would do is call them a 10% trend or a 5% trend, and that's based on the smoothing constant, which governs how fast the moving average responds to price changes. And so, for example, in this one day here, when you have a big move down in the daily breadth number, the 10% trend will move 10% of that distance. That just governs the speed at which it adjusts to the data. Most people are used to talking about exponential moving averages with a number of days instead of the old-fashioned terminology that we still use, just because we have always used it and think it's right to honor it. So there's a conversion formula, 2 divided by n plus 1, where n is the number of periods. So if you imagine 19 periods in that formula, you got 2 divided by 20, or 1/10, as a 10% trend. That's how you do the conversion. Back in the 1960s and 70s, when my parents were doing it, it was all manual calculations on scratch paper and tabulated in a ledger, and then hand plotted onto a graph paper. This is from 1976. This is my mother's handwriting. So you can see for each of these days, you have the advanced decline numbers, and she would hand calculate the 10% trend and the 5% trend based on the advanced decline number. And in doing this, just looking at the 10% trend and the 5% trend, the light bulb moment came in 1969 when they wondered, well, what about the difference between the 10% trend and the 5% trend? And that's what they came to know as the 10-5 oscillator, or the McClellan oscillator. The interesting bit of history is that it was in the same time in 1969 that Gerald Appel first thought to look at the difference between 2 moving averages and what came to be known by him as moving average convergence and divergence. 2 people on opposite sides of the country with no communication between them just happened at the same time in history to come up with this idea to look at the difference between 2 moving averages. So if you have a longer plot, like I have in this chart, of the daily advanced decline difference, you can see a red line is a 10% trend and the green line is the 5% trend. And when those two get further apart, you have a bigger difference. And so that's the value of the McClellan oscillator. When they're right next to each other, right on top of each other, then the McClellan oscillator is at 0. If they get separated again, then the McClellan oscillator can go negative. So that at its heart is what the McClellan oscillator is. It's a difference between 2 moving averages of the daily breadth, and it signals acceleration upward or acceleration downward when it goes to a high positive or a high negative. If it's at 0, it means that there's no acceleration taking place. Now, stock charts users, if you go and search on McClellan oscillator, or just even McClellan, you're confronted with 2 pages of all the indicators that Chip has had his guys program and put in there. It's a little bit daunting to try to pick among them and know what to look at. So the McClellan oscillator that I'm talking about, the one that my parents created, is what Chip calls the traditional version, or the classic version. And we'll get into some of the other versions as we go along here. If you look at it on stockcharts.com, you just pull up that symbol, and then this is what you get. And one thing that's missing from the plot is there's no 0 line that's evident. And that's important because it really matters whether the McClellan oscillator is positive or negative. I put this together back on Friday, so these are not quite up to date, but I wanted to have it in a way that made sense. So there's some modifications you can do in the chart menu in stockcharts.com to make a plot that looks a little bit easier to look at. First thing to do is get rid of the 2 moving averages that pop up standard, because those just kind of get in the way and clutter up the view. The other thing you can do is you can add a 0 line. And that's pretty easy to do. You just add in the chart menu, add horizontal line and set the parameter to 0, and it'll put a nice 0 line on there. So you can see when it's positive much more easily, and you can see when it's negative much more easily. And it kind of gives you a frame of reference to see how far down is down and how far up is up. The best way to use it, though, is in conjunction with price. And so you put a price on the top. Here I have the S&P 500. Usually when you put a chart up on top in stock charts, it'll be a little bit scrunched. So you select the height 1.0 option to get a much more expansive view, so you can see what prices are doing. And then you have a nice view where you can see what both indicators are doing in parallel and get some useful insights. One of the issues that we have to grapple with is that the number of issues that are traded on the New York Stock Exchange and the NASDAQ changes over time. The most dramatic change was in the NASDAQ. Not many people know this. You think about the technology bubble, the internet bubble peaking in 2000. Well, the number of issues traded on the NASDAQ actually peaked in December of 1996. And by the time you got to 2000, it had already been falling quite a bit as all these little .coms that came public and hoped somebody would buy them out were going broke, and not very many of them were getting bought out. There was also a change in the NYSE back in 2008 when they spun off the ARCA from their numbers. For a while, there were ETFs that were traded on the NYSE and that contributed to the advanced decline numbers. That's no longer the case. But so you have changing numbers, and what that does is it changes the amplitude of any calculations you do on the daily breadth numbers. So years ago, in a way to grapple with that, we came up with what we call the ratio adjusted calculation, where we take advances minus declines, we divide it by advances plus declines, and that ratio gets you a tiny little number that your brain can't handle very well. So we just multiplied the result by 1,000, and it takes it back up into the realm of where real numbers are and that our brains can grapple with. What we're effectively doing is that we're pretending that there are always exactly 1,000 stocks trading every day and never varying, and using the ratio to adjust that so that we can get some indicators that have a consistent amplitude. Here's a comparison between, this was supposed to be between the, here's the ratio adjusted version, the NYMO without the T on it, and this is versus the traditional version on top. And you can see there's not much difference between the plots during this time frame because there's not that much change in the number of issues. But you will see a difference in the value because there's 3,300 stocks trading. So if you divide the regular value by 3.3, you'll get the ratio adjusted version. So from a chart perspective, there's not much difference in the way you look at it. Either of them is fine, but you have to know what you're looking at and understand it. If you look at it over a much longer time frame, though, using the McClellan summation index that my parents also developed, you can start to see where the amplitude ramps up. This is going from 1990 all the way to 2011, and the summation index, you can see increasing amplitudes owing to the greater number of issues that were traded on the NYSE. In the ratio adjusted summation index, though, the amplitudes stay much more consistent. The summation index is an idea that my mother had. She was a math major. My dad was a business major, and it really took both of them together to team up and first of all, come up with it and plot it and make sense out of it. She had known doing integral calculus about integrating the area under the curve. And so when they looked at the McClellan Oscillator plot, they said, well, let's integrate the area under the curve. And that's just by summing all previous McClellan Oscillator values. And so the summation index is going to change every day by the amount of the value of the oscillator. And so in stockcharts.com, the $sign NYSI gets you the ratio adjusted version. If you want the traditional version, you just add a T on the end of that. Here is a chart of the ratio adjusted summation index. This is almost up to date. And it does a really, really fascinating thing. In addition to, it goes up rapidly when prices are going up rapidly, and it goes down when prices are consolidating. There's a magic thing that happens at the 500 level. And that's why I've drawn these dashed lines on. If the summation index, or the ratio adjusted summation index, can get up well above the plus 500 level, that we call that achieving escape velocity. It says that there's so much upward acceleration taking place in the advanced decline statistics that there's a gush of new money and you're immunized to some extent from having a really bad correction or a bear market. What you see often is that final tops remove, like we had in 2012, occur when the ratio adjusted summation index is below 500. And so if you're at a new high, like we had in summer of 2015, but the ratio adjusted summation index is below 500, that's not a good sign. Later that year, the market tried to rally back, but you could only get up to plus 500, and that was a bad sign. And so in 2016, we had a low again. Ever since that January 2016 low, though, very strong and upward initiation, very high readings for the summation index. We're still up above plus 500 right now in January 2018. So we have some degree of immunity today from having a really serious decline. That could change, though, as if we start to see some negative oscillator values taking the summation index back down below 500. And even as prices advance, that'll be the worry, and that'll be what we are going to look for in the weeks ahead. Here's another example at this point. This is a flashback chart this is 1998 up to 2008. Then 2008 especially, we were seeing higher highs made late that year in 2007, and the ratio adjusted summation index was not making it up. We're not making it up until early 2008. This is saying there is bad news. This is bad times. This is not a really good thing that is happening because the breadth numbers are just not supporting the price action. And that was a useful insight to get back then. So turning to the menu in stock charts, there are all sorts of different versions of the McClellan Oscillator you can get. The math is the same. You're still having a 10% trend and a 5% trend. of advanced decline statistics, but you can, for example, have the advanced decline numbers from just the 100 stocks in the OEX or the S&P 100, or just from the 500 stocks in the S&P 500, or just from the stocks in the Dow, or just from the Toronto Stock Exchange. There's lots of different ways you can look at it if that's what turns you on. Chip has done a great job of amassing this great list of things for us to look at. Whether you can get insights from them or not out of that long menu of all these different permutations, that's a different question and a harder question to answer that we would need all day to go through all that to come up with a more refined answer. But they're available to you to take a look at. One of the things you need to know about advanced decline statistics is that they're not all created equal. We prefer the NYSE numbers, the New York Stock Exchange numbers, because they tend to be the best numbers. The NASDAQ advanced decline statistics have a tremendously negative bias to them. And that's because if you are a brand new company that's going to go public and then go broke, you're more likely to do that on the NASDAQ than you are on the NYSE. And so that's why a little trivia question I like to ask: when was the last time that the NASDAQ advanced decline line, the cumulative daily advanced decline line, when was the last time it made a new all-time high? And it's a trick question because it's never made a new all-time high. It started going down from the beginning way back off the chart in 1971, and it's never been back there ever since then. And that's just something you have to know. You can still look at the acceleration upward that takes place in it, and that's why the McClellan Oscillator and Summation Index are good tools for that. But in terms of just looking at the raw data, you have to understand that it has this negative bias. One area of breadth statistics that I really like to look at, especially lately, I like to look at advanced decline data on high yield corporate bonds. It's tough to get. FINRA makes it available on their website, and there's a long path right there to get to it. And you got to hand compile it because they don't make a historical data available, but it's really juicy data because the high yield bonds tend to be among the most liquidity sensitive issues that are out there. They're the canaries in the coal mine. When the oxygen starts to dry up, they will be the ones that suffer. We saw that back in 2015, where we saw a divergence in the advanced decline line for these corporate bonds versus prices. And they were saying well ahead of the China mini crash, they were saying well ahead and then that liquidity was a problem. They kept saying that all the way to early 2016. And then suddenly they said liquidity has been restored and we got this great uptrend. Right now we're getting a similar message. They peaked back in September to October, I can't remember the exact date, and have not confirmed these higher highs that we're seeing in the stock market. So the stock market is coasting higher by channeling the liquidity that's available into the right stocks, but the most liquidity sensitive issues are suffering. Just as by way of a historical flashback, here's that 2007 period again. Here's that final price top. The corporate high yield bond AD line had peaked all the way back in May, well ahead of the New York Stock Exchange advanced decline line and the common stock advanced decline line. These guys were saying early on that there was liquidity problems, and they set it all the way down, all the way till March 2009, when they were making a higher low and saying, hey, liquidity is starting to get better, and look how they responded, zooming up to higher highs, even ahead of prices. So if you want to know what liquidity is doing, these are the guys to watch, which is really, it's nobody would think that you would get a good answer from junk bonds, but they really are the place to go that has the answer. If we have time, I want to get into something really fun, something new and different that I've come up with in the recent years. Tom and Aaron, do we have time to look at it?
Absolutely. Absolutely. We still have at least 10 to 15 minutes, so go for it.
I like to look at the commitment of traders data, which is published every week by the CFTC. And one bit of that data is about euro-dollar futures. And this is where we get the really fun insight. Now, the term euro-dollar here is not referring to a currency contract. This is an interest rate contract. What it means is dollar-denominated time deposits in European banks. So if you think of euro-dollar futures, it's really like LIBOR futures. So you're looking at what the banks are doing, trading these futures contracts back and forth among each other to lay off their interest rate risk. And what the great insight I found, not until 2010, was that this data on the net position of the commercial traders tends to lead the movements of the stock market by about a year. And it's been working ever since around 1997, which is when this contract really first took off in the banking system as a big part of how banks manage their risk. And so what you see in this chart, the red line is that plot of the Eurodollar commitment of traders data. It's shifted forward a year. So here's right now in that data versus right now in prices. We've shifted it forward to reveal how the bottoms and tops line up in the S&P 500. And we're basically getting a roadmap, an imperfect roadmap, but a pretty good roadmap a year ahead of time of what's likely to happen to the stock market. Let me zoom in a little bit closer. Here's that 2003 bottom, which this knew about ahead of time. Here's the rally up to the 2007 top, which it correctly described, and the decline from that. Once again, this is shifted forward a year, so we're getting the answer a year ahead of time. It ran into trouble during QE3 when the Fed started printing money and lifting the market in ways that the 1 year leading indication had not contemplated. But once the Fed got done with that, then they got back together, and here we are having the difficulty that it knew about in 2015 and 16. Here's the great uptrend that we're in the middle of right now and headed toward a peak just ahead of us. And that peak, I'm zooming in a little bit more, that peak is ideally due first week of March 2018. It'll be the echo of the all-time high in this data back in March 2017. And it shows us a pretty meaningful decline this coming summer to a bottom that equates to August 29th, but then we should rebound nice and strongly into year end. So whereas 2017 wasn't really a great year for market timers, and we knew that because this was showing a nearly linear advance, 2018 is going to be a much better time to know when to be in and when to not be in. As with anything that gives you an answer a year ahead of time, events can come along. So like this indicator didn't know about the shock we had with Brexit. And the election in November of 2016 kind of bent this bottom a little bit later, but then it took off like a rocket once again. You had little other news items. We had the Ebola panic that this indicator didn't know about a year ahead of time. But once we got through that panic, it rebounded and got back on track. So there are going to be anomalies that don't match up exactly with the pattern, but it's really it's pretty close to being the holy grail for knowing ahead of time what the market's going to do.
That is fascinating. Now I have a question for you.
Sure.
So based on the decline that you're showing, where you're saying maybe it would equate to maybe approximately an August 29th bottom, is there any way of knowing have you looked at it to see whether it's accurate in terms of the percentage decline that you might expect on the S&P 500, or is this just signaling that we're going to probably have a period in 2018 where we do run into some rough patches?
That's a really good question, and I wish I had a better answer, but I don't have one. The thing to understand is that the stock market can go from lower left to upper right, and it's not bound in its magnitude at all. This indicator operates horizontally. It goes up and down above a neutral level. And so it's only going to tell you about when are the up and down phases and when are the tops and bottoms likely to be seen. It's not going to tell you exactly what the magnitude is going to be. It's going to hint at it, but it's not going to tell you exactly. We can see that the magnitude of this decline in the Eurodollar commitment of traders data is pretty significant. It's similar to what we saw over here in 2015, and that was a turbulent period you'd want to know about. It didn't exactly get the pattern of the stock market right exactly, but it got the turning points pretty well, and it told you when you were in an upward trending phase and when you were not likely to not be in one. So I'm very concerned about this period, but at the same time, I'm also very excited about getting back on board in late August for a rally into year end. The interesting thing that this could do, though, is that a rising stock market tends to be good for the party that's in power in Washington, D.C. And so as we're facing a midterm election in November of 2018, that'll be happening in the context of a market that was declining into an August low and then rebounding. So it'll be fascinating for those who watch politics to see, well, will we get enough of a rebound to sweeten everybody's mood going into that November election, or will everybody still be pretty sour based on what happened in the summertime? Now, having said that, I'm talking about this big March 2018 high for prices. It's the echo of the March 2017 high for this indicator. We're not seeing any signs of weakness yet in terms of the New York advanced decline line making divergence, in terms of the ratio adjusted summation making divergence. We're not yet seeing that, but it is still only January, so we have a little bit of time to start putting together those indicators of a top. But it's not here yet. And I'll bring the presentation to a close by showing one of my favorite slides, and then let people know if they're interested how they can find out more about the work that we do. We have a twice monthly newsletter. We have a daily edition. We have a free weekly Chart in Focus article series that you can sign up for free, no strings attached, and we won't sell your email address to anybody. Just go to our website. You can sign up for that. You can also follow me on Twitter. And with that, I'll take the remaining time and answer questions that you guys may want to pose.
I know you're also in the Top Advisors corner on the Stock Charts blog page, I believe.
Yes.
Yep. So you can also read Tom there.
This is going to be some interesting. I'm going to have some fun too, Tom. This is going to be interesting because I'm a historian. So I have followed the stock market, and I really pay attention to historical trends in the market. And we're about to end, well, let me say that we're about to end one of the most bullish period of the year historically, October 27th at the close through January 18th at the close on the S&P 500 has averaged rising 4.4% since 1950. The S&P 500 overall during the year since 1950 has averaged rising a little more than 9%. So roughly one half of the S&P 500 gains historically have been earned from October 27th to January 18th. And of course, today is January 17th. Now, you might say, well, I'm ready to run for the exits then based on everything. But I'll also say this, that when we have years or when we have this period from October 27th to January 18th that is very strong, we tend to follow it with 3 more months of strength. And just to give you some information, the 16 best October 27th close to January 18th close periods, if we look at just the best 16 of those, they average going up 11.41%. The next 3 months of those 16 years average going up another 5.8%. And I'm sorry I don't have graphs on here to show everyone. You kind of have to follow along. But the point is that strength, historically, the strength that we see from October, end of October through mid-January, if we do have a really strong period, it tends, in most cases, to be followed by another 3 months of strength, which would take us out to April. And your indicator that you were showing was showing a top potentially maybe around March. So I just wanted to throw this out there because once we get past April, I think a lot of folks know about, go away in May kind of a thing. And I'm not a huge proponent of that because there are parts of the market that tend to do really well in May and June into the first half of July. But the summertime historically is the worst time of the year, no doubt, in the stock market. So while your indicator there is rebounding, that look at the euro dollar, while it's rebounding after the August 29th low, that really does kind of coincide with the history of the stock market where we tend to see strength through April. And then we start to roll over. And if we're going to see weakness, we see it during the summer months, particularly July, August, and September. And then you see another rebound later, or I shouldn't say you, but your euro dollar chart that you show there is suggesting later in the year we'll have another push to the upside. My point here is that this tends to coincide almost to the day or month with a seasonal pattern in the stock market. So I just thought I'd throw that out there as well. Just tells us maybe.
I would note that the ultimate high for this indicator says March, but there's a little bit of a right shoulder in May, and I wouldn't try to say now that the highest high for prices couldn't be in May. It could very well happen that way, but then you get the sharp drop off after that. So everybody knows about sell in May and go away, and we have that phrase mostly because it rhymes, and the human brain is funny. We believe things that rhyme more than things that don't. The annual seasonal pattern actually peaks in June, but you can't come up with a phrase that says sell in June and something that rhymes. You can't find one. That's why we still have stuck with sell in May, and that's why people still believe that. But yeah, so it'll be a fun time once we get to around May. I wouldn't necessarily think you got to pull the ripcord in March just because that's what this says, but you got to be holding the D-ring and getting ready to. And then your better time to expect meaningful downward movement would be between May and August.
Well, I have a saying. It says, it's time to fly. It's mid-July.
That's right.
That's what I've come up with. That's all I can come up with. I haven't been able to get anything that's catchier than that. Let me ask you a couple more questions, though. First, what's your style in trading the market? I mean, do you trade individual stocks? Are you more active? Are you a position trader? Are you longer term? What's your style?
I'm a market timer. And so I want to know what the overall market's going to do, and then I want to trade that and not expose myself to individual stock risk very much at all. For my own account, I do dabble a little bit in that, but that's not my main focus. I'm trying to ride the major trends and figure out what the overall market's going to do. My mother, she passed away in 2003, but she had a great saying. She said, everyone times the market. Some people buy when they have money and sell when they need money, while others use methods that are more sophisticated.
Correct.
That's kind of my approach. I want to have an answer ahead of time of what's supposed to happen, which is why I love having this euro-dollar indicator. I know what is supposed to happen. And then I want to have other tools that tell me what is happening. And when the two of those align with each other, then I can trade with greater confidence and probably greater leverage. When I see conflicting signals between what is happening and what should be happening, then I get a little bit more cautious and I pare back and I don't go as aggressively. But when all the planets are aligning and the trend is running nicely, then I'm happy to be part of that. I will note that right now I am out of the market and slightly short because there's a little bit of a step right here in that euro-dollar pattern, a little bit of a hitch, and we saw a little bit of weakness on Tuesday. Was expecting it to follow through, and maybe we'll see that. There is also, just on the annual seasonal pattern separate from this chart, there is a seasonal bottom around January 23rd that I expect to have some meaning. But then we get zooming back up again and headed toward that March top.
Yeah, very interesting. So it's safe to say that you use the euro dollar as your primary indicator on what's going to take place in the stock market, and that you use your summation and the McClellan Oscillator more as confirmation?
Well, I use a variety of things to get an answer about what is supposed to happen. The euro dollar, I've only known about this. I only discovered it in 2010. It's been working since 1997 without anybody knowing about it until I put it together and looked at it on a chart in 2010. So I like to look at anything that's going to give me a reliable answer about what's likely to happen. And sometimes that's a presidential cycle, sometimes that's other cycles. But my key is I want to have an idea of what's supposed to happen, and I want to have indicators that tell me what is happening, and I want those two to agree as much as possible.
What would your strategy be later this year then? I mean, if we get closer to March, April, and May, whatever, and you start to see signs of a top, do you short?
Yes, in our newsletter, we will tell people we're bullish, bearish, or neutral. We sub-advise for a managed accounts program that trades actual money in mutual funds, and we can go short in that, and we frequently do. So what I'll be looking for as we get close, we talked about the divergences that we're seeing already in the high yield bonds. This is the earliest of the early warnings trouble signs. But I also talked about the ratio adjusted summation index up here, and it is still above plus 500. So it's still saying, no, there's no worry, there's no trouble. You can have an ordinary garden variety correction at any time, but you're not going to start a bear market from right here. If we see the prices continue upward toward March to May, and we start to see this deteriorating and getting below plus 500, that'll be the confirmation that I would be looking for to say, yes, things are starting to put themselves together to give us a meaningful decline this summer. We don't have that yet. That's what we'll be looking forward to. But for now, it's still an uptrend. And so you should still trade with the trend or have a really good reason why you aren't going to.
You mentioned earlier that the oscillators that you follow, the McClellan oscillators, are very similar to the MACD and that they use exponential moving averages. Do you follow the MACD at all?
No, we use our own things. We use what we call the McClellan price oscillator, which looks at prices in the same way that MACD does. We just use a 10% trend and a 5% trend of the closing price. So that'd be a 19 and a 39 day. It looks very much like a MACD. There's not that much difference. They're both going to move up and move down in sympathy with prices. You may get slight differences in the moment when the turn appears. And there's not a huge difference. I can't construct for you an argument about advantage or disadvantage. It's just kind of a preference. And you use certain indicators, you get used to looking at them and you know their personality and you're comfortable with them. And so that's what you stick with.
Yeah, absolutely. I know exactly what you're talking
Yes.
about. I know the PPO actually is better than the MACD. I mean, they're basically the same thing, but one's the price difference and the other's the dollar difference. And so I know the PPO is better to use, but it's like you said, it's kind of what you get used to. And I've always used that MACD.
Well, and PPO is actually a variation on this theme that we're talking about, using the raw numbers or the ratio adjusted numbers. You're
Right.
factoring out the magnitude of price change from having an impact on the magnitude of the indicator. It's the same idea.
Yep.
Yeah,
Exactly.
I think the PMO is better than both of them, but I'm kind of biased on that one.
Hey, I just want to point out to everybody on the screen you have there your website, www.mcoscillator, OSCILLATOR. And there you go. There, it's highlighted in blue right in the middle of the screen, www.mcoscillator.com. You can check it out. Tom, this has been an absolutely fascinating discussion. We definitely want to get you back.
Thank you.
Yes,
Awesome.
I'm really excited that you came on. I remember Gene Morgan. My dad and I would come home at lunch and turn that KWHY on, and I'd watch Gene Morgan and all those charts. So I have to say, when I first met you, I was a little starstruck.
And the thing that Gene Morgan did, which was a great gift to so many people, is that he showed you that you could look at a chart and get useful information from it, which back in the 1960s was considered heresy by a lot of people. The chartists back then had to hide their chart books from their bosses so they wouldn't get fired for engaging in voodoo. But he really showed a lot of people, and it was West Coast people that got this message before the East Coast ever did, because people who passed through LA could watch KWHY, that there's information in charts. And that was a great gift to give up to so many people.
Yes, absolutely. And I'm going to steal the screen just really quickly. I know we're getting ready to start that 10 and 10, but I wanted to show people how you can get those McClellan Oscillator charts ready-made if you use the Decision Point chart pack. So I'm going to just go down to my chart list so you can see what I'm talking about. So anyway, we have our market indicators chart pack for Decision Point, free download for extra members and above. And in here, we have the McClellan Oscillator, the McClellan Volume Oscillator. And if you come into those chart lists, you're going to have ready-made for all of these indexes and such. So I'll pull up just one so we can see what it looks like. And there you go. So we already have the price on it, the actual McClellan Oscillator numbers there, summation, et cetera. And then there's the ratio you can look at as well that is used to calculate it. So that's an easy place to go. And all you do to get chart packs is go to your account and under chart packs, manage chart packs, and there you go. And you can download them. I have to say, admittedly, that our market indicator chart pack does have some blank charts in it just because we did redo a bunch of our indicators and we lost a few. So we're in the process of cleaning that up, but that's the market indicators chart pack is where you can go for that.
Aaron,
Awesome.
one thing I would add to what you just showed, the McClellan Oscillator chart you just had on there shows a negative value. And people should understand when they're looking at that, that's yesterday. We don't yet know the closing numbers for today. You can look at the advanced decline numbers for today and you can do some what if analysis and pretend that if we close with the number I'm seeing right now, then we would see a positive oscillator. But you don't do that yet because it's an end of day closing indicator. So people should just understand that even though other price charts on stockcharts.com are going to be updated for what's happening intraday, the closing value indicators like the McClellan Oscillator are not going to be updated until the end of the day.
Yep. Very good. It's been great having you here. I know that we've had lots of positive comments here in the chat room and actually a lot of quietness. So they were listening very intently to you. So the euro dollar index, somebody was asking, is dollar XED on stock charts. So that's where you can get the euro dollar index ticker.
But that's not the commitment of traders data, which as far as I know, stock charts does not offer.
Correct. You do have to go to Tom's website and get that information and find out how you can create it yourself, or it's already there if you're on his website.
All right. Thanks so much for stopping by, Tom. We're definitely going to have you back.
Thank you very much, guys.
Mm-hmm.
Awesome. And there he goes, Tom McClellan. I tell you what, that was fascinating.
Absolutely.
I think probably part of the reason it was quiet was that, I mean, I was just in awe watching that, looking at how that predicts a year ahead of time. I mean, like Tom pointed out, outside of just a couple periods, there'd be no way to know, what's going to happen. Other than that, I think if you smoothed it over, it literally almost was an overlay of the stock market, which is really
yes,
wild.
No, that was very eye-opening, and I have followed some of that data on his website, or really through the newsletters. So it's great data. It is really impressive when you can get anything like that. It's nothing's magic, but certainly that's pretty good.
We get so many great discussions on different ways to look at the market. I mean, obviously that was a new one to me. I had never seen that before, and very fascinating. I think if you find some of these indications that are favorites of yours and you can follow them, I think that the odds of being able to time the market better than most everyone else in the market really goes up. But anyhow, let's switch over. I know we've got the 10 and 10. I did annotate the first chart, just annotated it. And so Finisar was our first stock. Okay.
Finisar.
Yeah, I was just looking at, I mean, after we had this huge gap up in December with heavy volume, I believe that was earnings related, but I'm not 100% sure. But after that gap up, we did come all the way back down. And by the way, when you get a gap up and see a black candle, the ensuing move to the downside is typically what I would expect. Normally when you get a gap up, if you just think about the way the stock market works, when everyone wants to buy, you don't have the same number of sellers as you have buyers. That's why you're getting the gap up to begin with. But when you get that gap up, a lot of times market makers, that's their role in the market, is to provide liquidity. So when everybody else wants to buy and there's not enough sellers, market makers take short positions. And so when you get a black candle, essentially what that means is that the market makers have slowed the progress to the upside after that opening gap higher. And so if they're on the short side, they normally make money. I'm not going to say, and they'll tell you they don't make money on every trade, but typically over the course of weeks and months, they make money. So if they're selling and into that gap and you see a reversing candle like that, I'm not going to say what the percentage is. I've never done a study, but I'm going to guess that most of the time you're going to see some additional weakness in the short term. So it's really important to start looking for key support levels. In this case, we reversed before we got down to gap support, and we did go a little bit below the moving averages, but we quickly recovered. And I put these green arrows in here just to show that the rising 20-day moving average has been showing some pretty good support. And that blue circle shows that right now we're sitting just beneath that 20-day moving average, 9 cents below it. So this is an area where I think it's pretty important for Finisar technically to rally off of here and eventually make a move back up to test the top of that gap at 24.50.
All right, sounds good. And let's see, our next one for you is going to be GPI, Group Automotive. Group 1 Automotive, it looks
All right, I think we're getting a handle off of a cup. So I like the pattern overall. You can see that clearly we have a resistance level at about $84. We did come back down and putting this cup in. We came all the way back down into this gap support zone. So there's the top of gap support. There's the bottom of gap support. So we came back into this area, came back up. I think we have a rounded cup here, or maybe not quite so rounded. Could be a little bit better, but this is a pretty nice pattern off of an uptrend. Pull back to the rising 20-day moving average. I would expect it to hold and then get a breakout. So I am bullish GPI, at least as long as it continues to trade above its 20-day moving average.
All right. Next one I have for you is Texas Instruments, TXN, having a really good day today.
Yeah, the semis are having a fantastic day, or at least they were earlier. So I'm sure Texas Instruments is following along in sympathy. Let's see, TXN. Yeah, beautiful day. And I think I saw maybe on a question, and I don't know if it was in the chat room, wondering where to set a stop. They don't want to give it all the way down to the 20-day moving average. Honestly, when you're in a move like this, it's really hard to find an area. I mean, it's going up just about every day, putting in higher lows. So if you wanted to keep a really tight stop, I would just say first day it prints a lower low. Maybe consider taking your position off the table, or maybe half the position, and then maybe leaving the other half for the 20-day. I'm not quite sure. But what I can tell you is that there is a lot of accumulation going on. Anytime you see a stock moving higher this quickly, and then you take a look and you see the volume that has been coming into the stock for the last 6 to 7 weeks, I think this is a clear-cut sign that the stock is being heavily accumulated, which I think bodes well for it. But short term, yeah, it could get a pullback at any time. It's very overbought. I personally would be using the 20-day moving average.
All right. See, the next one we have is Target, TGT.
All right, TGT. Well, first of all, it's in a pretty good space. Again, it has been, this particular area of the market has been rising. We've seen Walmart, we've seen a number of companies, Kohl's, Target, all of these companies doing really well. And I think that bodes well. Seasonally, many of these stocks tend to do well in the later in the first quarter and into the beginning of the second quarter. February through April tends to be really strong for a lot of the department stores, retailers, and so forth. But Target, I think technically is overbought. But other than that, there's really not much that I don't like about it. I think a couple of key areas would be maybe down around 69 if the market goes through a period where maybe we see some rotation. Really, the last time we saw any consolidation was back when we broke out of it in mid-December, and that's back closer, maybe 63. But right now, Target at $77. Again, this is another one. MACD looks great. I think as long as it continues to trade above that 20-day moving average, I would just hang on to it.
All right. Let's see. The next one I have for you is CNP, and that would be Centerpoint Energy Utilities.
Yeah, starting to make a comeback. Actually, utilities hit a key support area recently, and I actually wrote about that in my blog this morning. I wouldn't be surprised to see utilities lead, at least in the short term. We've got the 10-year Treasury yield near resistance and the XLU near support. So I think part of this is just the fact that the overall group maybe just got a little bit oversold. But notice the declining 20-day moving average. That has been key resistance. I'm not going to say it's going to hold or it's going to fail, but I certainly would be watching it. Here you can see back in mid-December, there is your test. You can see another one late December, a couple more in early January. I mean, this has been a clear-cut area where you want to sell, and take a look at what we did today. Let me see if I can get that in there a little better. There we go. So we tested that 20-day again. I do think this. It seems like the MACD is starting to flatten. So if we do fail at the 20 and go back down one more time, I think there's a good chance we're going to get a really solid positive divergence here. And it's also occurring not too far above where we've had some really solid support. So Centerpoint Energy, as it's pulled back, I think is starting to look much, much better from a reward to risk standpoint. Although from a very short-term perspective, I would not be jumping in here because we're right up against a resistance level that's been holding the stock back for the past 6-7 weeks.
Okay. Number 6, MetLife, MET.
Well, I still think we're in a period where we're going to continue to see rising Treasury yields. That's what the Fed keeps telling us. I think we're going to see it. And MetLife, of course, is in the life insurance space where we tend to see a lot of outperformance when Treasury yields are rising. The life insurance company and banks are two interest-sensitive groups that tend to do extremely well when we have that kind of situation where we do see a lot of selling in treasuries and yields moving higher. So I would be looking for a bullish outcome here. So for me, that means I would probably be looking at maybe the recent highs. We're dipping back. We've dipped back down below that. But off of an uptrend, what I was seeing maybe is a little bit of a wedge off of this uptrend. And we broke out. Volume was okay on the breakout. I'd want to get back up above. We have held this 20-day moving average. We closed just below it yesterday, but we're back up above it. I'd like to see that continue. Stay above that 20, get back up here and take out the recent highs. And I think that would lead to some more strength ahead.
Okay. Next one is Floor and Decor Holdings, FND.
Oops, FND.
Yes, is in November.
Okay, pretty nice little uptrend here. And the volume seems to have picked up recently. I can see back in September, October, volume might have been an issue, but it does seem to be more heavily traded. And as it continues to rise, we do see the rising 20-day moving average holding. The one problem, I guess, in the near term would be if you put this support resistance line right here. Check out yesterday, we tried to make the breakout intraday and failed and came back down. So I think we're up against, at least in the short term, a little bit of resistance. I'd be a little concerned about that. And if we do make a breakout, I want to see volume confirm, because clearly we have a lower MACD. It's not even close. So if we break out, we're going to break out with a negative divergence. So therefore, I want to make sure that the volume confirms. Otherwise, I'm going to be really skeptical about that breakout. To the downside, I think the recent low I would be watching. So I think for now, at least, we're in a range from roughly 44 to 50.
Okay. Next one I have for you, number 8, Bluebird Bio, which is blue.
Yeah, there was a big announcement. I was trying to think earlier. I meant to talk about it in the technical news. There was I think it may be JUNO. I'm going to come back to blue, but I think it was JUNO that was up so big. Yeah, this is a company that actually there were talks. I don't know if it was a formal agreement or just talks to be acquired by Celgene. But this is a biotech stock you can see is up 47% today on the news. I'm assuming it's more than just a rumor, given that kind of a push to the upside. But now going back to blue, I know a lot of the biotech, especially some of the smaller biotechs, are reacting pretty bullishly off of that news. This is another perfect example of a stock that comes out with news, gaps up, prints a black candle. I mean, I don't make this stuff up. But right here, you can see that black candle off of the huge gap up. That means that, again, we gapped up, and pretty much the high was the open, and we saw selling the rest of the day. A lot of times that's an indication market makers are in on it on the short side, and that's when you want to be very careful. A couple of key support levels. One was gap support, which was right there, and the other was probably that prior low. And you can see after dipping into that area, actually starting to turn back to the upside. I think this one from a reward to risk standpoint looks pretty good. The closer you get it into the 160, 170 range, the better I like it, because I would have a stop probably below 160. But this one has a lot of room back up to that 220 level. So I do like blue.
All right. 3D Systems Corp, DDD.
Yeah, DDD actually had news this morning with Stryker, SYK, about some kind of a surgery. I'm not quite sure what the fundamental news was. I just saw it coming across the wires. But I will say that I'd like to see the 20-day moving average here hold. We do have some increasing volume today, but we broke out above the 20 and above recent highs. And so this is the 20-day moving average where we had climbed above on some pretty decent volume. I would like to hold that level because we already have lost some price support with today's action. You can see right here the prior high back in mid-December was at about $10.50. We got up to almost $12 before coming back down. But I'd like to see this 20-day moving average hold, knowing that it's been in this longer-term downtrend. I just don't want to see it fall back below the 20-day. I mean, you can see other periods where after we topped, we went above the 20. And as soon as we went below the 20, you can see the selling continue. Here again, we go above the 20. Once we sell, get below that 20, it starts again. So here it looks like more of a rounded bottom, maybe even an exhaustion move to the downside. So I now want to hold this rising 20-day moving average.
Okay. And the final one is Ingersoll Rand, which is IR. And my PMO is topping here. So even though it's holding the 20, I would be cautious.
Yeah, I'm still okay as long as the 20 holds. I mean, that's what's been holding the stock for the past month, maybe 5 weeks or so. So I think, again, as long as that rising 20-day moving average continues to hold, just kind of point out a few of these where we have pulled back and held it. I think that typically is, important. We do have a price support level. Maybe if you want to give it a little bit more room, here was a breakout. And this, again, was another gap up on pretty good volume with a black candle. You can see it work its way back down, fill the gap, hit the 20-day, and then break out again with heavy volume. that level held on the last pullback. So I would be looking short-term, very short-term support at the rising 20-day, which is 89.62. And then I think you have price support about 88.5 or so. So those are the two levels I'd watch on Ingersoll. As long as they hold, I'd be okay with the stock.
Okay. And that is a completion of the 10 and 10. And as you can see, these were the symbols that we covered. And with that, I'm going to go into our final market update. There we go. All right. So as we can see at this point, we've got, let's see, why is this? This isn't sharing correctly. Hold on. There we go. All right. So as we can see, we've got the major markets are on their way up. We really aren't seeing a pullback at this point. NASDAQ, same as S&P and Dow. Russell 2000 small caps are making their way up a little slower than we're seeing on the other major indexes. The TSX is on the high side here, getting ready to go back up and test some intraday highs. And we can see that TNX Treasury yields are up, but currently hitting this area of resistance. I think you had already talked about a little bit, Tom. UUP, the dollar has, gapped up earlier, but now we're seeing it fall greatly, I would say. And now, of course, we're looking at it on the negative side. You can see with commodities, they're up slightly, probably a lot due to USO and it being on the positive side, getting ready to test some intraday highs. Gold was down, and as the dollar fell, of course, gold was able to enjoy a bit of a rally here, trying to make up some of the losses that incurred around lunchtime. Declines are leading advances, and notice the VIX, we got all the way up to about a 1275 reading, and it is starting to pull back. And I'm just going to give myself a few kudos here. But remember, when I was talking to you about the VIX, and you could see on the chart that it was hitting the bottom Bollinger Band, that typically to me is a sign that the next day or two we're going to see rally. And we saw a rally today. So not sure if that's going to continue through. But typically when I see those high readings, as far as the next day or two are concerned, I look for the opposite to occur. It's sentiment, after all. Okay, so let's go to our market summary. I'm going to give you a quick peek at where we're looking as far as our sector spiders are concerned. And at this point, as Tom mentioned at the beginning of the show, we're seeing all of our sector spiders higher, with consumer staples and healthcare leading the way. Financials are moving up slightly, but they are the laggards as far as the sectors go. U.S. industries, the only one negative right now are banks. And you can see biotechs and semis are leading the market right now as far as the industries are concerned. China ETF, let's see, Russia and China ETFs are leading the way, both up almost 2% now. You can see Belgium and Spain are the laggards, and actually the only two currently, well, actually the only one negative right now is Belgium. So looking pretty good there. Let's go take a quick peek at our, here we go, at our scooter movers right now. Top up, as we can see, BACHF right now is the biggest scooter mover. Looks like more of a penny stock there, but IBM is in the lead. And I know we looked at that. I think we looked at this one earlier. And as well, we're seeing, look at Intel is in here. I'm going to show that one because that's always a popular one. We can see it's coming in off of this rounded bottom, but we're still stuck under that 20-day EMA. But it is encouraging to see the scooter starting to move back up. But volume patterns, not really that pretty at this point with that OBV turning straight down. And with that, I'm going to complete our final market update. And I know we have some interesting information to share as far as bear markets are concerned. So I'm going to let you take off with that, Tom, and start it if that's fine with you.
Are you ready? I mean, you've got the screen.
I do have the screen. I have to share a different screen, but I can do that. So we were talking about, for this particular segment, to look at, people are always wondering about bear markets and how we can find them and how we should look for them. I'm going to fix my screen because I can tell already you're not being able to see it all. I'll be momentarily with you. Okay, here we go. That's better. All right, so I'm looking at a weekly chart. For me, the way it's so we're all sitting here and we talked with Tom McClellan and he showed us the divergences and how he uses commitment of traders. We're all kind of wondering right now, what should we look for a new bear market? I mean, it's the new normal has been straight up and maybe some consolidation, but all of us want to know, when should we really start worrying, I guess? What do you look for before a bear market? And so what I wanted to show you is I think the best indicators for me are the weekly and monthly PMOs. The monthly PMOs I think are better, but I wanted to show you both right now. So this is a weekly chart, and I'm of the S&P, and it goes back, I believe this one is a 7-year, 10-year chart. And I've marked whenever we've gotten sell signals. And of course, I didn't mark all of them, but I wanted to show you typically what we look for. Now, of course, you look at this and those sell signals, they came in, we got a little bit of decline, but it wasn't the beginning of a bear market. And that's why I want to go to my monthly chart. All right, so this is only the previous, as you can see, 20 years. And we don't get a lot of signals on the monthly PMO, which is why I think it's really an excellent tool to use as far as looking for bear market signals, because we don't get a lot of them. I mean, this is a 20-year chart and we have 3 sell signals on it, but look at when they came in. They were pretty accurate. So that's what we'll be looking for. And currently, we're on a long-term PMO buy signal. So it's really at this point, as far as our signals are concerned, we really don't need to worry just yet. If we start seeing this monthly PMO start topping, then we might want to get worried. And you can see in the thumbnail back here, we did get that top below the signal line, which was a little bit nerve-wracking, I suppose you could say. But it immediately turned back up, and we did end up getting that buy signal. And I'm going to show you my long-term monthly chart just to give you an even better picture of these signals. There we go. This is a monthly chart of the S&P 500. And this is the monthly PMO. And I have marked off the sell signals. And again, we don't get very many of them, but they tend to be quite accurate. Now, of course, here we had that crash at the end of 87, and we got that sell signal. Didn't turn out to be a new bear market necessarily, but we did end up with that, of course, very deep decline. But the main thing is when you look at this chart, these are the signals I'm going to look for to see if we're going to get a turn on a bear market. Because since the late 90s, I think, of course, we're only looking at 3 signals, but I think they're quite accurate. I think they're good to look for. And so that's what I'm going to be watching for, Tom. I mean, that's really, to me, what's going to signal time to worry. And at this point, I'm not seeing that we're going to see a huge, bear market turn at this point, just looking at the monthly PMO. And that's pretty much what I'm looking for as far as bear market characteristics. And at this point, as I said, I don't see it, not for a while.
Yeah, I look at a couple of different things. I mean, number one, I do try to pay attention to a lot of the seasonal tendencies. I generally, even though the 2007 to 2009 bear market began in October, it tends to be kind of unusual. And in fact, there were periods where actually we bounced back. This is a chart that the top is the S&P 500, and I know this is kind of a squished chart. I wouldn't worry too much about the readings, just kind of the lines and the direction that they're going in. But you can see at the end of 2007, we topped in October, and that's what launched us into a pretty significant bear market. And the things that I tend to look for when I'm looking at a chart like this, and I think I'm going to go back even a little bit further, and I don't know if a monthly will help us, but let's go back first, maybe around 14 years, and I'm going to switch it to a monthly and see if I can still get these signals up, see if they show. Yeah, I think you can see it. So here's where the S&P 500 topped. This was October 2007. So you can see the bull market continued moving on. Now, just like Tom McClellan was talking about earlier, it's always helpful if you can start to get some warning signs about the market moving higher when you get some negative divergences or things taking place underneath the surface of the market that you need to be concerned about. For me, one of my favorite relative ratios is the XLY versus the XLP, which is consumer discretionary versus consumer staples. That's just telling me where the money is rotating among consumer stocks. And anytime that ratio is rising, it just makes me feel better about the market because money is rotating into discretionary areas. And those are the companies that sell us the things that we want as opposed to the things that we need. So when you're feeling wealthier, you're feeling better about your job, you're feeling better about your retirement account, you're feeling better about your house value, you don't mind going out and spending $4 or $5 at Starbucks. And that's really, in a nutshell, it's very, that's a huge simplification. But essentially, that's what this ratio tells me, is that when this XLY, XLP ratio is climbing, that tends to tell us that traders are much more interested in the discretionary stocks, which tends to suggest that our economy not only is strengthening, but is continuing to, or we're expecting it to continue to strengthen. So here's a look at the XLY, XLP ratio back as the S&P 500 was hitting its high in October 2007. We were starting to see deterioration long before that top. And we actually had broken down to a multi-year low just about the same time the S&P 500 was topping. That's telling me money is rotating toward defense. That's not what you want to see in a bull market. You want to see money rotating toward offense. So come over here to the transportation versus utility index. And again, the S&P 500 tops in late 2007, but this ratio of transports versus utilities was declining, telling us that the more defensive utilities were seeing rotation into that space. We don't want to see that. Here's the banks versus the REITs. So when you're looking at the financials, the banks tend to do well during strong economies. The REITs tend to be more defensive. They have high dividend yields and so forth. And when the economy's struggling, the banks tend to take it on the chin. Lower interest rates, try and help with the struggling economy. Hurts their net interest margins. And then also a struggling economy can lead to higher loan losses. So your banks tend to underperform REITs during periods like that. So you can see all three of these indicators were looking pretty weak going into 2007, 2008. Technology had been kind of weak at that point. Industrials kind of flat. And even, this was the consumer discretionary versus the S&P 500, but flattening. Now, I want you to fast forward from then to what we're looking at now. And first of all, you can see that the consumer discretionary group is on the verge of making another breakout. I'd like to see that confirm. Industrials on a relative basis to the S&P have already broken out. Technology already has broken out. And you can see that the banks relative to the REITs have been strengthening. The transports versus utilities have broken out. And here's the XLY versus the XLP. It's broken out. So I'm not seeing that rotation that would bother me yet. Again, when I look at today's action, we had the big selling yesterday, led by many of the key aggressive areas. And when we were looking earlier at the strength that was returning into the market, when I pull that up and go into the sector summary, consumer staples and healthcare, two of the three defensive areas of the market, utilities being the other, these are some of the leaders in the rally today. Now, one day, I was looking at a monthly chart. So to come back and look at one day and say, oh, consumer staples is leading, we must be entering a bear market, that is way, that's just a little bit too much interpretation into what this is telling us. But it is possibly at least a warning sign in the near term, because I don't want to see this rally continue with consumer staples and healthcare and utilities up toward the top of the leaderboard. What we have been seeing is the exact opposite. If we, again, go back over the last 3 months, look at what's on the bottom. Consumer staples, healthcare, and utilities. These are the three groups that have been lagging. The money has been rotating into aggressive areas. So if the market breaks out again here, I really want to see that money rotate back into aggressive areas. I do not want to see the key areas like the XLK, XLI, XLY, and XLF all struggle to get back to new highs. That to me would be a short-term warning sign. Now, that doesn't change what we were just looking at in terms of the, try and get that. Yeah, the relative ratios. These ratios took place over a long period of time when they were declining. One day is not going to change this ratio. So what I'm thinking is, and I'm a little nervous about the near term. Tom earlier said that he had moved into a short position versus the market because of a little bit of a decline he saw. I actually have raised a bunch of cash here between yesterday and today because I am a little nervous about this move to the upside being on the backs of defensive stocks. I'm not really trusting this market right now, knowing that we're getting toward the end of a very bullish period, and just the fact that we're at the time of the month where we tend to see the market pull back. Keep in mind, there is a ton of in the money call premium right now because a lot of folks been playing calls. We've got options that will be expiring later this week, and so I think the combination of this could lead to some more selling in the near term. So I just don't want to take any chances. It's not that I'm bearish. I just think we've run quite a bit, and the market's starting to show me short-term signs that maybe we've run a little bit too much. A lot of companies coming out with good earnings, and we're not seeing follow-through. It seems like a lot of that is being priced in. So there are just some short-term warning signs. I would prefer to see the market maybe pull back, consolidate for a little bit, unwind some of these overbought oscillators, and then I think we could potentially have another run to the upside, as history tells us. Mm-hmm. Normally, when we're really strong heading into the middle part of January, as I pointed out earlier, the next 3 months do tend to be very strong as well.
Have you heard the saying, as they say, I think it's the January effect or barometer, that as January goes, so goes the market for the year?
Yeah, I have a spreadsheet.
Yeah, how does that work out?
For the most part, it works out very well. There have been a couple of big exceptions. I think it was might have been 2009 that opened really bad in January, and of course, then we hit the bottom of the bear market in March, and then the market rallied. Mm-hmm. So it was a very poor signal that year, and it may have been either 2007 or 2008 that we had a really strong January, and then the market fell apart. So there have been exceptions to the rule. But yes, there's an overwhelming amount of evidence that suggests when the market does really well in the month of January, that it tends to do extremely well the balance of the year. So if, for instance, January goes up 7%, I'm not saying that year is going to be up 10%, another 3%. What typically happens is if January is up 7%, you might see another 15% the balance of the year from February through the end of the year. But I've done presentations on that. Maybe that would be a good one for later in January or early February. Talk about the January effect.
Absolutely. All right. Gosh, we're getting to the end of the show already. I can't believe it.
That is it. I mean, we got a lot in today, believe it or not. I mean, having Tom McClellan on was awesome.
I absolutely adore him. And as I mentioned, I mean, I've been following his parents' work since, early 80s on that LA station, KWHY. So really interesting stuff. And immediately, I mean, seriously, though, Tom, Gene Morgan had giant poster board. I mean, those big old poster boards, and it was like hand done charts so that it was on the poster board big enough so everybody could see the McClellan Oscillator and see the summation index and see how they all work together. It was absolutely fascinating and truly was the moment in time that I got very interested in the stock market. And it's really the McClellans who did that, and my dad too.
Yeah, I know I used to do a lot of stuff manually as well on ledger sheets and stuff, and I know you've talked about it. It's kind of interesting seeing copies of
yes.
All of that data. It brought back a lot of memories because before charts, I did a lot of that myself.
Exactly. That's why I love the OBV. I used, that's how I calculated it, just like that.
All right. Well, we are at the end of another show. let you go ahead and give everybody the upcoming schedule here.
Yes, Greg's going to be on the show tomorrow. And he's going to go over some point and figure charts. And then following that, on Friday, I'm going to be giving a discussion on our DP market indicators. And the McClellan Oscillator is included in that. That's one of the market indicators we use. And as you just saw in the bear market, the PMO, the monthly PMO, is a market indicator as well. And that does complete it. So I know that, Tom was great. And I know we've got some more guests lined up in the coming weeks, but we're not going to tell you yet.
We have some very interesting guests coming up for sure. Again, I want to thank Tom for stopping by. That was a great presentation. We really enjoyed it. Very eye-opening material. And I want to thank all of you for being with us today. Please remember to complete the survey as you exit. It's located in the bottom right-hand part of your screen under How'd We Do. It's a very brief survey. We'd love to get your feedback, to hear what you think of Market Watchers Live. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. See you on Thursday. Happy trading.